Hey everybody, welcome to Everything Accounting. I'm Alfred, your friendly neighborhood CPA, and today I wanted to talk to you guys about capital gains. So capital gains and capital gains tax are essentially, for those that don't know, any assets that you hold and then sell later for a profit. The profit on that is called capital gains. So these are essentially investment properties that you may have, or stocks when you're not a stockbroker, so not your active business being stocks, or any other investment that could have come up. Land is a great one, or cars, which normally they don't turn a profit, but some do, like supercars. But there are certain items where when you buy it at, say, $10,000 and then you sell it for $12,000, that $2,000 difference is your capital gains. So the government obviously has to tax for that because you've made a profit. The way that it works in Canada, or at least the way that it works currently, is that your tax is on the profit at your tax rate times 50%. So when they say the capital gains tax rate is 50%, it's not that 50% of your profit goes to taxes. It's that 50% of your tax rate in that year is then taxed at 50% on that profit. So if the only thing that you did was sell property, let's say as an example, and you made $100,000, then based on your tax rate, approximately 35%, depending on the province that you're in. So you do 35%, and this is where you get your trusty calculator. 35% of 100,000 is 35,000. Then 50% of that is your tax rate. So you get to $17,500. That's essentially how it works. So every person's marginal tax rate is very different. You might have people that are making 27% in tax or paying 35, like we just used in the example, 40, 50%. It all depends on the province that you're in as well, because that takes into account different factors. Now, there's a new tax rule coming out where they said they jumped the taxes from 50% to 66.67%. People are freaking out, and rightfully so. But it's worse when you don't fully understand how the math works. So prior to, like I said, if you were in the top tax bracket for the year, in most provinces, that's around 50%. So typically what was happening at that tax bracket was 50% times 50% times the profit or your capital gains. So you basically hit 25% tax on your capital gains. Now we're looking at approximately 32%. But the caveat with this new rule is that if you have earned anything above $250,000, that is being taxed at that new tax rate. So anything under, so if you're selling stocks, let's say, on the side, and you made 20,000 or 100,000, you had a killer year and you hit 200,000. Great. That's still taxed at the old tax rate. So you're still getting taxed the 50% on your tax rate. Anything above 250,000, though, that is essentially going to be taxed at the 66.67%. When we look at stuff like that, it's a massive impact for those that have rental properties, especially in booming markets like Vancouver and Toronto. Those neighborhoods, you're not buying these properties for less than $1 million. So essentially, if you bought a property over there for $1 million, let's say you're in Vancouver and you bought it for $1 million, and then later on, a couple years later, 5 years later, 10 years later, you want to sell it for 1.5. The 1.5 is essentially $500,000 in profit or capital gains, meaning that 32% is going to hit your tax. And basically, the $500,000 goes to $160,000 in taxes in that year. So people in those neighborhoods that have investment properties are freaking out. And again, rightfully so. But one thing you also have to remember is that this is not for all properties. Primary residence, so the homes that you live in, are non-taxable. And the government just assumes that you're going to use the funds and the proceeds that you receive from selling your primary residence to buy another residence. A lot of people that I know, as an example, have one property that they used as their investment. So they've been paying into it for years over years over years. And then eventually when they want to retire, they're going to sell the property for a profit, downgrade essentially, buy a smaller place to retire in. Your taxes are not going to impact that. There won't be any tax implication on the sale of your primary residence. You just need to be sure that any other investments that you're doing, you're going to get taxed on. So in terms of tax rates, in terms of capital gains, this is just one that confuses and stresses out a lot of people. But really, the method in terms of capital gains, and the thing that you have to be concerned of the most, is planning accordingly with your tax accountant. So I have people reaching out to me right now because from our understanding, the rule is going to be implemented July 1st of this year in 2024. So people are freaking out, and we're basically sitting down calculating out what the difference in terms of tax implication would be on their capital gains if they were to sell prior to or after, and what the value is. Essentially what's going to end up happening, and this is just my methodology and my thought process, is there's going to be a lot less sales because there's a lot less benefit to sell, especially in the investment property market. So people are going to be holding on to investment properties. Now, in places like Vancouver, where they have an empty homes tax, that's going to be an impact as well. So they'll want to rent out these properties. So that also means that there's going to be a lot more rental properties and a lot more people willing to rent out their property, pay a little bit of tax on the rental income that's coming in, way less than what they would be paying on capital gains as a dollar figure, and just continue to rent out their properties. What may also happen is that there's going to be a lot less people willing to buy investment properties because that is a massive capital influx and a massive cost. So the people that have been buying up properties all around, and I'm sure you've seen it in your neighborhoods, that there's investment groups or people buying up multiple plots of land consistently. I see it out here in Edmonton all the time. But essentially what you're going to see is people slowing down their purchases because they've increased their tax rate by 8% in one go. 8% doesn't seem like a lot, but it can be when it adds up. So you just want to make sure when you're talking investments, when you're talking about capital gains, when you're talking about any passive income, you understand the implications, you understand the consequences or the impact that you're putting yourself in order to buy that investment. One rule of thumb that I always tell my clients, I always tell my friends when they're buying property or they're buying investments or whatever they're buying in terms of, investing in their future, it's great to do, except that you're gonna pay tax. It's something that people always forget, and they're like, oh, I see a massive profit, but then they get hit with a tax bill and they're like, this is way too much, I can't afford it. Well, technically you can, because you sold property and you have profitability. Otherwise, you wouldn't have been taxed. So one thing that you have to always consider and always plan for and always account for is taxes. You're going to pay it either way. So if you account for that, and if you properly plan for purchasing any investments, and you know for a fact that you're going to be paying your taxes, it's not going to be as big of a concern as it is now. So talk to your tax accountant, talk to your financial advisor, make sure that you have the right people in hand that are helping you out and guiding you to make the right moves for you. If this new capital gains rule comes into play and impacts you significantly and you don't know who to talk to, come talk to me. Leave me a comment below, reach out, emails at Glow Consulting. We're happy to help you out. We will happily work through any tax advice that you need and make sure that you're making the right move for you. As always, this is Alfred, your friendly neighborhood CPA. This has been Everything Accounting, and we've been talking about capital gains. If you have any questions about capital gains, obviously feel free to reach out to the Government of Canada as well. They will have a lot of resources on it, but definitely talk to an accountant. Thanks again. Subscribe, comment, and I'm looking forward to chatting with you soon.